U.S. crude oil stockpiles up by more than 690,000 barrels last week. There was an estimated drop, a small drop, was forecast of 225,000. There are persistent concerns over disruption following Russia's attack on Ukraine. We're joined now by Marshall Steeves, energy markets analyst at S&P Global. Marshall, thanks very much indeed for coming to the show. Great to see you again.
Thanks. Good morning, Andrew.
Anything jump out for you with these inventory numbers?
Yeah, I think the headline number you just cited was a little bit surprising, the crude stock build. I think in the prior week there had been a record level of exports, so I think there was a bit of a reaction to that and sort of a reversion to the mean, if you will. Also, in terms of the what they call domestic disappearance or demand data, gasoline demand, implied demand was down a little bit. It's averaging below the year-ago level. It's down about 2.2% if you look over a 4-week average. And distillate demand is also being destroyed, if you will, or marginally a marginal decline as well. So I think that there is some indication of some price elasticity, there as well.
Oh, so diesel demand or diesel consumption actually coming down because of these prices?
Yeah, a little bit. I mean, I think we saw it a little bit more in the gasoline. The implied distillate demand number was actually up fractionally, about 12,000 barrels per day. But over the course of time, over the course of a 4-week average, it's showing some signs of wear and tear.
Because we have been seeing, I think it's record diesel prices, or certainly prices higher than in 2008.
That's true. Though demand has been impacted, supply has been impacted even more so, for a variety of reasons. It hasn't been able to keep pace with the tepid demand growth that we have seen up until now. I think that's a function of coming out of the pandemic and also a function of refinery turnarounds. Mm-hmm. So we may see that pick up as the summer goes on. But you're right, there's problems all up and down the barrelhead with respect to distillates. If you look at diesel, if you look at jet fuel, there have been spot shortages of jet, and that may come to pass with distillate as well if we continue to see this tightness persist.
Yeah, and apparently in the United States, distillate stockpiles, which include diesel, have fallen to the lowest since 2008. There's massive diesel exports.
Exactly. As I mentioned, we saw a record level of crude and refined product exports the week before last. So that really put a lot of pressure on stockpiles, both of crude and the refined products as well. Now, with respect to what's happening with Russia, we're seeing a lot of a switch, if you will, to reliance on North Sea crudes, which would include Brent. So that's putting pressure on the Brent market there, and that's spilling over to a certain degree to the North American markets as well.
Globally, pretty low stockpiles of distillates?
Yeah, absolutely. As you mentioned, not only is it the case that we're seeing 14-year lows here in North America and U.S. and Canada, but in Europe as well. So there's a lot of pressures globally with respect to distillates. Yes.
Do you think, I know this is a political question, the Germans are apparently saying we're willing to stop Russian oil if everybody else does. Do you think we will see an actual significant cutoff in Russian oil exports into Europe, for example?
Yeah, I think at some point we probably will. I think within the EU there's a lot of willingness to do so. I think that part of it was there was a desire to get sort of the French election behind us. So with the re-election of Macron, I think that perhaps we'll move ahead with that. It's really, I guess, logistics questions of whether Germany can become reliant on other sources. I think they're moving in that direction. So I think, yes, probably sooner rather than later, we'll see that sanction.
You are cautioning investors to expect more volatile trading in a wide range for oil.
Yeah, exactly. I mean, we see sort of these divergent forces on the market. The lockdowns in China, which appear to be continuing in Shanghai, and now they're spreading to Beijing, and perhaps in the future to other cities as well. So these are the most severe lockdowns that we've seen since Wuhan 2 years ago. So that's definitely having a lot of demand destruction there. And it remains to be seen how widespread it might become or how long lasting it might be. So that's sort of a pressure on the market. And then we have the supply issues that we just discussed, which are supportive. So you have the offsetting factors, and that's why we see a volatile trading range.
Just switching to gasoline, you have near record gasoline prices in the United States, but apparently American motorists are still willing to pay up. There hasn't been a drop in demand for gas.
Well, for the most part, there's been a modest decrease year on year, as I mentioned earlier. But yeah, with sort of to the degree that's happening, the return to work phenomenon here, that's sort of offsetting whatever demand destruction there might be for leisure travel, for example, and a little bit of pickup in business travel, but although it's very light, but that's helping offset losses in the leisure category. So yeah, gasoline demand is still firm, and also I should mention some states have temporarily withheld their gas taxes, their sales taxes on gasoline. So those will probably persist through the summer. So that's alleviated some tension, maybe taking off 25, 30 cents per gallon.
As you know, WTI crude got north of $120 in March. Do you think it's going to get back up to that level anytime soon?
It could, I would say, if all Russian exports were to be ceased in any manner. There are also things, Libyan exports were upheld or held up because of civil strife there. We've yet to see a resolution of the JCPOA with Iran, which could bring another 1 million barrels per day to the market. Venezuela, if there's a rapprochement between Venezuela and the U.S., we could see exports increase there. But as I say, I think that Russia will continue to export certainly to China and India, and for the time being to Europe, particularly Germany, until, as we discussed, those sanctions are imposed.
Marshall, before we let you go, you have been following energy markets for a while. Has this been, since the Russian attack on Ukraine in late February, has this been the biggest transformation of the energy market in decades, or is that going too far?
Yeah, that might be overstating a little bit. I mean, we had a very volatile time after Hurricane Katrina and some other hurricanes back in 2005. But clearly, I think that it's a turning point in the sense that we're starting to see a turn in investment towards alternative fuels. So I think that the extent to which we're seeing a decline in sort of the traditional carbon-based oil and gas investments, that's going to have a deleterious impact on supply growth going forward, and has really been a source of support in the market over the last year already.
Marshall, it's always great talking to you, and thanks very much.
Thank you.
Marshall Steves, energy markets analyst at S&P Global.